lot of times in higher density cities, you're going to have, it's not just raw land. It might be a small building, or like we've bought a single family commercial, or no, single story commercial building that's there, like an old bar. And that we tore that down and built a 50-unit building in that place. But there was a tenant paying rent there. So if you have that sort of scenario, that's ideal for the seller. If they don't mind holding it longer term, they're getting some rental income still. Or for you, if you have to close on it quicker, you're at least still getting some money in to offset your holding costs.
Got it. Welcome to Real Estate Hustlers Podcast. I'm your host, Josh Appleman, and today we're joined with Harry Arsene. Harry is the co-founder and manager of Arsene Construction, a Seattle-based real estate development and contracting firm with degrees in mechanical and product development engineering. He leads the acquisitions, financing, and operations with a technical edge. Harry, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Josh, thanks for having me. It's my wife and I. We have a general contracting company and development company based out of Seattle. We focus specifically in the Seattle market. We started out back in 2007, and we started out doing flips, got into single family new construction about a few years into starting the business, and then grew into townhouse projects, and then eventually multifamily development, which is, I think, what we're going to cover today.
That's great. Yeah, for sure. And getting into development, it can be extremely tough because you're dealing with something that is speculative versus already cash flowing, and then you can improve the property and raise the rents and all that good stuff. Can you tell us about some challenges that you faced and what you've learned along the way so far?
Yeah, definitely. So to go back a step, we kind of stumbled into multifamily. We were looking at a townhouse site that was also permitted for multifamily, and we said, "Hey, this might be a good time to try out the multifamily game." But yeah, it's a completely different beast than residential. Your utility improvements are considerably larger. Street improvements that the city usually throws on. It may be particular to Seattle, but I imagine a lot of major cities have a lot of the same obstacles. Your permitting timelines are a lot longer for larger projects that require design review. So overall, it's just a longer life cycle for the entire project. And going from residential to multifamily, some of those contractors or subcontractors don't transition well either. So if you're used to doing residential and you're moving into multifamily development, you kind of have to find a new crew of guys that are familiar with multifamily and know what it all entails. So yeah, there are a lot of challenges on like fire alarm systems, elevator, fire sprinklers, just things you wouldn't typically see on a single family or possibly townhouse project.
Yeah, very, very much more astute, knowing the codes, knowing what you're getting into, and then more than anything, the guys and the crews that can get things done on target on the timeline, because you're up against the timeline the entire process, because you've got a lot of cash out throughout the process of developing, and you got to get that cash back through draws. What are some things that you've learned that you wish you knew then that you know now?
The consultants that you use are extremely crucial. If you hiring an architect, you want to hire one that's seen multiple multifamily projects full cycle all the way through. So they've done the design, the entitlement, they've done the construction administration during the build process. So they've run into a lot of issues and they've worked through them already. We worked with somebody that didn't have as much multifamily experience. They were kind of going off on their own, and we were, we partnered with them to do it. And there were a lot of issues that came up in design after we started building. So surrounding yourself with consultants that have that experience, so they're not learning on your job, they've learned on others, and you're benefiting from that.
Yeah, well, you're not paying for their education. I can definitely appreciate that for sure.
Yeah.
That's a part of it. So let's get into say I find a piece of land. I'm in real estate right now and I want to get into development. What would be the first thing that I need to go out there and figure out before I start paying people to figure it out for me?
Sure. Assuming you like the location, you're right where you want to be. I would validate the density of the project. So check your zoning, see what you can get. In Seattle, there are a couple of different kinds of zoning for multifamily. You've got zoning that has to have one-to-one parking, one that has you have to park half the units. So if you have a 50-unit building, you've got to park 25 of the units, which is the limiter on the density usually. And then you have zones where you don't have any parking required, which happens as well in these urban villages, areas where they're trying to increase density. Um, but yeah, the utilities are a big one. Density is another big one. You want to know your market rents really well, and basically you start at your top line and back your way out to your net operating income. You start with the stabilized asset and figure out, once you have that density, you figure out your net operating income, find where your building value ends up. And then from there, you can figure out where you're going to end up with land price plus building costs. Do you have enough equity behind you to cover your holding costs, cover any cost overruns on construction, and potentially any snags on lease up or schedule delays? So yeah, that's basically how I go through it. When you
Where
look at
would
that, sorry, go
where would
ahead.
I go to find density at? And then what would density? How would I calculate how many units I could have once I find the density? Like, what would be the key wording that I'm looking for?
Sure. Some areas don't require any, they don't have any unit count limit, so no density limit, but they usually have a FAR limit, which stands for floor area ratio. So you have, say you've got a 10,000 square foot lot and you have a FAR of 4, that means you can build 40,000 gross square feet on that lot. But there are other limiters, like if they require green space, if they require parking. There's a lot of factors that go into it, so um, it's not a simple equation, and it's very jurisdiction specific. So you really have to get to know your local market, partner with an architect that can walk you through, maybe do one or two feasibilities with them, ask a lot of questions, get familiar with the typical big hitters that you run into in your local market, and that's essentially where I would start, and then go from there.
Maybe find somebody that you can work under, or get in with if you're young enough, I'd say get in with a firm and get the hands-on experience. Would that be a good approach?
Yeah, you're saying with an architecture firm, or are you saying with a general contracting
Maybe
firm?
yeah, a
Or
development firm, guys that are out there doing it, getting
yeah,
firsthand
then
experience.
yeah, that's ideal because you're learning from them. You're not risking anything at that point. You can also partner with a multifamily development operator or developer that is familiar with it, has gone through it several cycles.
Yeah.
That's that way you're getting the best of all worlds.
Yeah, that would be. So we've figured out the FAR FAR. We're now it works. We feel like we can build it. What would be the next approach that we need to go to before we start hiring people to figure it out for us?
So I'd figure out, it's so you've got your density, figure out your rents and your unit mix that you're trying to target, and it's never going to end up where you think it is. So if you're designing for a 60 unit building, I would back off a few units, because I'd probably underwrite it to 55 units, for example, just so that you've got that buffer, because things will come up in design review and the entitlement process that will essentially limit your density. I've had a lot of projects where I think I can get 70 units and I end up at 55, for example. So just kind of putting in that margin up front, and figuring out that market rent, your unit mix, and then figure out essentially your operating costs if you're once you're stabilized, and back into your net operating income. And then from there, you'll want to look at your local cap rates. You can get that from a broker. You could look at market sales in the area for typical buildings of that size. It could get a little tricky if there's not a lot of deal flow, like in the market the last 12 months. There hasn't been much deal flow. Um, but you'll figure out your cap rate, figure out your value, and then that will determine what you can pay for the land.
What expense ratio are you using for new construction?
I use somewhere between 25 and 28% for my operating expenses, and it
That's
can
good.
vary by market. In Seattle, they have a multifamily tax exemption program that allows you to essentially not have to pay property taxes on the improvements. So, and you have to set aside, I think it's 20%. It depends on your unit mix, but it's 20% of your units to 80% or 60% AMI, which stands for adjusted median income.
So you're doing affordable housing too. You're doing a percentage of your new developments affordable housing.
Uh, yeah, 20% of it is typically affordable, and it's still a market rate building, but
Yeah.
that you weigh the MFTE benefits versus what you're giving up on the market rate rental side, and it's typically a net benefit for the developer operator. So you see a lot of buildings, especially in the Seattle market, they take on this 12-year MFTE exemption, and
Smart.
the nice thing about it is you apply for it, you do it. If for some reason year 3 or year 4, their rents are restricting you to a point where you're not seeing a net benefit, you can opt out of the program. So that's I don't think I've
Okay.
seen anybody opt out of it, but you're not tied into it for the full 12 years. You can use it for as long as you want within that 12-year period. You can renew after 12 years, or you can essentially get out of it in any given year. But I don't think you can jump back in.
That's a lot. That's different than a LIHTC then, a full blown LIHTC development, because you're into it for 15 and then 15 extended use. So
Right. Yeah. No, it's completely different. It's more catered for market rate
yeah,
operators.
yeah, but that's a
And
huge benefit because you're controlling your biggest hard cost, which is taxes.
yeah, we really like it here, and it's definitely a net benefit. So you see a lot of people applying for that tax exemption here.
And that's
There
not
is
tax
paperwork
credits. It's
involved with it, but there is like some the bureaucracy behind. You have to get through that paperwork, but it's a net benefit.
yeah, for sure. And that's not tax credits. That's just deferred property, or not even deferred property taxes. It's just more or less a credit of property taxes.
It's waived essentially. Yeah.
Waived.
So
Okay.
you'll have say I'm just making numbers up. You have $1 million land valuation. You got $9 million improvement valuation, 10 million total. In Seattle, you'd only be taxed about 10,000. Is it 10,000? Yeah, 10,000 a year roughly on the $1 million of land value, and the 9 million in improvements is essentially exempt while you're in the program. So instead of paying 100,000 a year in property taxes, you're paying 10,000 a year. And
That's
I'm kind of
wild.
rounding the numbers, but yeah.
And you're only taking 20% of the units up for affordable housing. So you still generate that cash flow, but the rest are just market rate. And you can use Section 8 voucher overhang to really get
Yep.
those tenants to where they're market rate too, in a
Yeah, and
sense.
in a lot of cases, the market rate's in line with the MFTE rate.
Mhm.
There are sometimes you have even if it's in line, sometimes you have to discount the MFTE rates because there's a lot more paperwork involved for the tenant as well. So it takes a little more to get them to apply, and the process takes a little bit longer. So you have to keep the tenants engaged for longer. They may give up and go to another building that's market rate if they're not getting a net benefit on. So there's a little bit of a game you have to play there,
Got it.
but overall it's a great program for market rate units.
So
Developers.
we found a piece of land. It works on our performa. The underwriting looks good. We can get our density. Now, what's the next step? We before we start spending money, do we engage? Or is
Yeah,
there
you're pretty much at the point where you're going to spend money.
okay?
I would start doing initial feasibilities with the city. In Seattle, it's called a preliminary assessment report. I do a feasibility with the architect, talk to a good civil engineer, see what sort of utility improvements are going to be required. Yeah, you're at this point you're spending money to see now. Now that you've gotten to that hurdle, now you want to see, are there any other big ticket items you're going to get hit with? We've had a job where we had to do a sewer main extension. We weren't anticipating it. We even had an engineer do an analysis and show that it wasn't required, but the city still required the sewer main upsize. So that was a cost that we bore as the developer. So you want to look for those kinds of big ticket items. And
So
go
we
ahead.
get with the city, we set up a meeting with the city to see what kind of requirements they would have. And at that time, do we have the architect with us? Do we go get an engineering firm for the survey, or because
Uh,
we're going to have to get conceptual drawings done too, to see if
sure. Yeah, and yeah, you'd engage with a surveyor early on, assuming you've got it under contract, you're happy with the price, you're in your due diligence period. You want to make sure you don't have any encroachments. That's another key item, especially in higher density cities. You'll have buildings really close to each other. Sometimes um, you'll have a neighboring property's utilities on your property, or you'll have fence line encroachments or even building encroachments. Like they're essentially sitting on your legal parcel, so that's gonna affect your density, because you're gonna have to set back your building a certain amount, even though they may be on your property. They're essentially grandfathered in. But yeah, surveyor, civil engineer, architect to start feasibility, and I would engage with the architect to talk with the city. It's good to be involved in the process, but I also think it's good to have the consultants that have that experience to essentially hold your hand through the process.
how much cash do you think should be allocated for just the soft cost going into it? Minus a
Good question.
E&D on the land, just soft cost feasibility. Say the thing blows up, it doesn't work out. How much do you feel like
You
is
could probably get away with somewhere between $4,000 and $7,000, I would say. Um, 2 to 3,000 for the survey, 2 to 3,000 for feasibility with the architecture firm, and then throw another thousand or so in there for miscellaneous, maybe some consulting fees for with the city, or whatever else might come up. That's probably a fair number, 7,000 or less.
how? What should the PSA should say for as far as a closing timeline? Is it 3 months, 6 months?
It depends. Oh, if you're trying to get developer terms, I mean, the ideal is close on permits, and that could be up to 2 years. We've had some closings that are 18 months long. That's holding costs that you don't have to pay out, and
Yeah.
you can sell that to the seller as, the more time you give me, the more money I can give you, because you're essentially holding it for me. So yeah, you want to get as much time as you can. Get your financing contingency in there if you're not sure how you're going to fund it. Those are some key items.
Got it. That's a good point. You have to get the seller to play ball too. Of course, if they're selling land, they kind of sign up for it. They have to get the project has to go through approvals for it to even make sense.
Yeah,
Um,
and a lot of times in higher density cities, you're going to have, it's not just raw land. It might be a small building, or like we've bought a single family commercial, or no, single story commercial building that's there, like an old bar, and that we tore that down and built a 50-unit building in that place. But there was a tenant paying rent there, so if you have that sort of scenario, that's ideal for the seller. If they don't mind holding it longer term, they're getting some rental income still. Or for you, if you have to close on it quicker, you're at least still getting some money in to offset your holding costs.
Got it. At what point do we engage with the bank? I mean, we of course we have to have our numbers. We have to have estimates. Uh, Say we've engaged with the architect, the city, everyone's on board, and I guess the architect has taken over and they've sent out for pricing, or is that something you're doing on your end?
For the financing, you want to get that engaged as quickly as possible. So once you've got your pro forma and your construction budget, you've essentially got enough to go to a lender, have them order appraisal. If you're at that phase, a commercial appraisal is going to cost you somewhere between $3,500 and $6,500. It's a lot more than residential. But if you're at that point, you've essentially gotten to a place in your due diligence where you feel comfortable with the price, the density, and barring any major obstacles that you find along the way, you plan on moving forward.
What are you seeing with banks and the terms that they're presenting right now?
It's a whole spectrum. So if you go to traditional banks, you're going to be down to 60% loan to cost, 65% loan to cost. Then you've got other lenders. I hesitate to call them hard money lenders. They're not really like hard money lenders, but they're asset-based lenders that also look at your net worth and liquidity, and they can give you higher leverages. So we've done a project at 85% loan to cost. So if it's a $10 million project, you're bringing $1.5 million in. There's a very wide spectrum. Obviously, if you've got more capital and you have a very strong balance sheet, you want to go with more of a traditional lender. But if you want to get a higher rate of return on your money and you don't mind taking on the risk of higher leverage, you can go to more like a hard money style lender that can give you the higher loan to cost, so that you can keep your money working at a higher rate of return.
Now, when you close on the bank financing, how much time goes by before you actually break ground typically?
So usually, if you're not closing on permits, you're getting usually like a 24-month acquisition loan, and if that's the case, say it's like a $2 million land purchase, they're going to require somewhere between 40 and 50% down if it's land only. Now, you bring up a good point actually. If you're buying a building, or if you're buying a property that has a building on it, you're going to be able to get higher leverage on your acquisition financing because there's an asset there already. If you're just buying raw land, you're going to be close to 50% down. Like I said, some lenders will go 40% down. But yeah, you want to have at least 24 months for your entitlement phase. You may need extensions on that acquisition loan. But if you're buying it and closing on permits, you're essentially going right into your construction financing. So they'll usually build in an interest reserve, and you've got I would say 18 months is the bare minimum I would do for a multifamily project, because you got to build it and then you've got to lease it up and stabilize it before you can take it into long-term financing.
So best case scenario is you're closing and permits are already pretty much printed and ready for you to go.
Yeah, that would be the best case scenario. Yeah, and then you'd want at least 18 months on your construction financing, and you want to have your lender build in extensions as well. Usually they'll do 1 or 2 extensions of 90 days each. You want to have that. You don't want to be in a situation where your lender wants to get paid off and you have to go to a bridge lender that's essentially you're not done or you're not leased up and you're trying to find this in between financing. There are plenty of lenders that do that, but you want to try to avoid that so you can move from your construction loan directly into your stabilized financing.
So do you all use investors for the equity portion?
On our larger projects, we do. The first one that we did, we funded ourselves. The last one we did, we have an equity partner on, and we've got a new one that we're kicking off that we're doing a raise for as well.
How do you promote that or present that to an investor?
So we put together an offering memorandum, and essentially breaks down all the numbers, what we're going to spend on it, where we think we're going to end up on value, the limited partners' anticipated returns, their preferred return. It's all detailed out. It gives a total return for the project and an anticipated timeline for exit.
So that's patient capital because they're not getting a pref during the construction, are they?
Right, they're not. The pref accumulates during construction.
Got it.
And it'll be paid out when there's a capital event. So say if we hold the property, stabilize it and hold it long term, there will be a capital event to refinance out of the construction loan and essentially return part of the original principal that was invested back to the investors. So they'd get that and they'd get their preferred return. And then it would go to some sort of cash flow split. There's 100 ways to do it, but that's the typical structure that you see out there.
Yeah, it's just keeping it balanced too, where the GP is fairly compensated for all the effort and energy, and then LPs feel like they're compensated for being patient capital.
Sure.
And knowing that there's a sign at the end of the finish line. It does take time. It's a lot of all the pre-planning, and then finally ground breaks, and then you're going through all the motions of construction, and timelines aren't hit, or are hit, the material purchasing, the scheduling. There's a ton involved, a lot of moving parts, and but at the end, you're left with a brand new building. It's brand new. So
Yeah, that's what we really like about. We actually really enjoy the whole process. We like knowing that we're the ones that built it. We know what went into it. We know it's brand new. It's not going to have any issues. Um,
yeah,
you're familiar with the building inside out. That's what we like about it.
yeah,
One thing I'll say on the investment front, if you're looking at a value add deal versus a development, you definitely want to get a higher rate of return on that development because
yeah.
like you said, you're that patient capital. So you got to get rewarded for that. So
Yeah, for sure. And there's risk, reward, and everything else. But at the end of the day, it's brand new. It's going to last decades and decades. I see the benefits for sure of development. There's risk, but it's just finding the land, finding the it's got to make sense. The area has to make sense, and then if you find a good area, you've got to have land. You've got to
yeah.
have just all the approvals that it takes. So it's definitely it's hats off for what you all are doing. What is a good learning lesson for the listeners to take away, and just a nugget that you've learned just by taking action?
I would say if you can find someone that's done it before, you really need to bend somebody's ear and ask a lot of questions. A lot of what we did through trial and error. We Permitting took a lot longer. We built it. We had major construction issues that we had to work through. A lot of things that we had to rework. So I just say the more questions you ask, find somebody that knows what they're doing and learn from them. Partner with them. Um, yeah, that's probably the best piece of advice I can give.
Yeah, I
You want to
agree.
learn from other people's mistakes as much as you can.
Especially like I'd mentioned soft costs because you're pulling that cash from somewhere, and that cash, it existed here before. Now you got to pull it in for this project, and if it doesn't work, then you've got to go out and make it again from somewhere. So
Yeah,
it's like you had said, knowing what the top line costs can be before you start engaging with people and creating brand new builds. That's where you become more savvy of an investor, and really, I think the vendors would appreciate that too,
yeah.
if that you are talking to. Um, and then, so you're also you've built up new relationships with construction teams and crews. So now you are going into your next build. You can do it a lot more faster, more effective, and you're building your teams up.
Yeah, that's what's great about it. We don't end up using all of the same subs, but you find two or three in the trades that you really like, and you use them again on the next one, and it just goes smoother and smoother. So
One more piece of advice to listeners: they want to go down the path of development. What would be their first starting point as far as any books that you would recommend or groups?
if there's a mastermind group in your area, that's a good way to network and be held accountable for what you're trying to do. I would say if you are going to do a mastermind, definitely have a clear objective before you go in there. You don't want to just go in and kind of um, kind of be aimless, if you will.
Yeah.
If you know these are the three things you want to do, go in there with those objectives, be vocal about it, and try to get the help to be successful. That's a good way. Yeah, I think there are like local meetups you can find, people doing multifamily. Just learn as much as you can. If you want to go off on your own on a project, I would say start with a smaller multifamily project. But again, bring in those experienced consultants and try to learn as much as you can from others.
Yep, I agree. I like it. Harry, if somebody wants to reach out, learn more about yourself, and possibly invest with you on your projects, how can they get a hold of you?
Yeah, they can contact us through our website, arseneconstruction.com. The name is right up in the top right corner there, ARSENE construction.com. I'm also on LinkedIn. If you guys want to reach out via LinkedIn, Harry Arsene. We have a company page as well, but you can reach out to me directly.
Very good. Harry, definitely appreciate your time today. Look forward to following you. We'll talk soon.
Cool. Thank you, Josh. I appreciate it.